Welcome to the Deep Dive, the place where we break down complex earnings calls so you can spend your time executing your own strategy.
And today we are tackling a big one.
We're doing a deep dive into the fiscal Q2 2026 video earnings webcast for the MedTech giant, Medtronic.
And this wasn't just, another quarterly call. This one, which happened pre-market on November 18th, was probably the most scrutinized of the quarter.
Why so much focus on this one in particular?
Well, for years now, management has been promising this fundamental acceleration in growth. They've been talking about their key strategic investments.
And investors were basically saying, show me the money.
Exactly. They were demanding proof that this long-awaited pivot was finally, translating into real financial performance.
And it sounds like they got it. Management, led by CEO Geoff Martha, didn't really hedge his language at all.
No, he came right out and said the growth acceleration is now fully underway. They are shifting to a decisive growth mindset.
Okay, so our mission today is to unpack exactly where that growth is coming from and, just as importantly, understand the financial trade-offs they're making to get it.
Let's do it.
Let's start with those headline numbers that really validated this whole change in direction.
All right, so if you just look at the income statement, this was, a profoundly clean beat. The company reported non-GAAP EPS of $1.36.
$1.36, and that sailed past consensus by 5 cents.
5 cents, which represents a strong 8% year-over-year growth. So a really solid number there.
And revenue also showed some pretty impressive strength. It landed at what, $8.961 billion?
Yep, $8.961 billion. That beat expectations by roughly $70 to $90 million. But here's the key metric, the one everyone was watching.
The organic growth.
The organic revenue growth. It accelerated sharply to 5.5%.
And when you look at how the market reacted, you can tell this wasn't just some beat they got by, trimming the fat.
Not at all. It was driven by genuine volume expansion and some serious new product momentum.
What's really fascinating here, though, and what I think speaks volumes about this new direction, is that they got this beat despite consciously, turning on the spending taps.
That's the key. Management explicitly said they scaled up manufacturing for new products, and they took the opportunity to aggressively increase OpEx.
Specifically in sales and R&D, right?
Right. SG&A and research and development, with R&D spend up almost 9% year over year.
Wait, let me just stop you there. We so often see MedTech companies focusing on margin expansion and, cost control.
Especially in tough quarters.
Exactly. But here, they beat expectations while increasing their spending. That tells you everything you need to know about the strategy.
It really does. They are prioritizing that top-line momentum, that market capture right now, even if it means sacrificing some immediate margin preservation.
It just solidifies that whole growth mindset shift you mentioned earlier.
It absolutely does. The story is no longer about maximizing efficiency on the products they already have.
Right.
It's about funding the platforms that promise the highest long-term return. They're deploying capital like a growth company again, which is, frankly, a massive conceptual shift for Medtronic.
Okay, so let's unpack where all this capital is going, because there is one segment that is just completely dominating the narrative here.
Oh, yeah.
And that's cardiovascular.
Yeah.
If there was a star player this quarter, this was it.
Undeniably, cardiovascular revenue hit $3.36 billion. It accelerated to 9.3% organic growth.
9.3%. Let's put that in perspective.
Okay, if you exclude the, immediate pandemic recovery comparisons, that is the strongest growth this portfolio has seen in over a decade.
A decade. Wow. And within that massive segment, we had to talk about pulse field ablation PFA.
The Cardiac Ablation Solutions business, or CAS, revenue there grew a stunning 71% globally.
71% is huge, but the U.S. numbers are what truly blew the roof off.
Yeah. Growth was over 300% year over year.
300% in the U.S.
That is a statement of intent in what is a $12 billion global market for EP ablation.
And this dominance is entirely because of this new PFA franchise, right?
Entirely. It uses non-thermal energy, so basically quick, highly targeted electrical pulses to treat atrial fibrillation.
Instead of the old ways of, heating or freezing tissue.
Exactly. Instead of radiofrequency or cryoablation. For the patient, this can mean faster procedures and fewer unintended side effects.
So how quickly is this PFA tech becoming, core to their business?
Well, PFA now accounts for 75% of their entire cardiac ablation revenue.
75%.
Already.
Already. And management noted the installed base of their Affera mapping system, that's the capital equipment you need to do the procedure, it actually doubled just this quarter.
Doubled in 1 quarter.
Which is why leadership is so confident. They expect to add a staggering $1 billion in incremental revenue from PSA alone. $1 billion. That would double the franchise's fiscal 2025 base.
Yeah. This immediately positions PFA as a multi-year share game story.
That is a huge target. And when you think about the competition, the whole EP ablation market is already growing in the mid-20s.
Right.
So Medtronic is basically planting a flag and saying they will aggressively take share from competitors like Boston Scientific and J&J.
That's the message. And the future pipeline is designed to sustain that momentum. They highlighted their next move, which is single-shot PFA.
Okay.
They submitted the IDE to the FDA for their Sphere 360 single-shot catheter. The trial for that is expected to start this quarter.
So this ensures PFA isn't just a flash in the pan.
Exactly. It makes it a core driver for years to come.
This phenomenal PFA growth, though, it brings us back to that financial trade-off we mentioned earlier. And I think we need to explain this in more detail.
Yeah, the margins.
The margins. The adjusted gross margin was up 70 basis points operationally, which is good, but that was mostly wiped out by an 80 basis point negative business mix headwind.
Right.
What does that actually mean in practical terms for you, the listener?
Okay, this is where the strategy really crystallizes. Think of the PFA system like a high-end printer.
Okay.
Medtronic is focused right now on getting the printer, the Affera capital equipment installed in hospitals as fast as possible.
And those initial machine sales, they carry lower margins.
Much lower margins. It's the loss leader, essentially.
Got it. The classic razor and blades.
Precisely. The real profit comes from the high-margin consumables, the catheters, the accessories that hospitals have to buy over and over again for every single patient.
So since that installed base is doubling, they're selling a lot of low-margin printers right now.
But the long-term goal is to shift that revenue mix heavily toward the recurring high-margin ink cartridges, the PFA catheters. That's what will drive margin expansion down the line.
So a crystal clear case of short-term pain for long-term gain.
That's the bet they're making.
All right, let's move beyond the cath lab. The second major growth lever, Symplicity RDN for hypertension. This story has had a long and bumpy history.
It has, which makes the news from this call even more significant. They finally received the final CMS National Coverage Determination, the NCD.
Which is basically the official green light from Medicare to cover the procedure.
Right. And management described it as broad and even better than anticipated. That's the real kicker here.
Why is better so critical? I mean, isn't just getting coverage enough?
It's all about removing the friction points for patients. The NCD successfully reduced barriers in the patient pathway.
Like what, for example?
For example, they cut the required time for patient adherence to medication from 12 months down to just 6.
Oh, that's a big deal.
It is. They also removed a significant kidney function exclusion, which opens the door to a much broader group of patients.
And this is crucial because the U.S. market for uncontrolled hypertension is just massive.
We're talking about 18 million patients.
18 million. That number is staggering. And the clinical data, it really backs up all the excitement.
Oh, absolutely. The 3-year data from their OnMed trial showed patients had a sustained 18-point average drop in systolic blood pressure.
Which, for a patient, is life-changing.
It's profoundly significant. In cardiology, a drop of even 5 or 10 points is considered a huge win for reducing the risk of stroke and heart attack.
So an 18-point sustained drop is a home run.
It shows that this therapy offers a truly differentiated, durable outcome for patients who just aren't responding to medication. The question is no longer if the opportunity is real,
but how fast they can scale it.
Exactly. How fast can they train the physicians and get hospital adoption up to speed?
Okay, moving quickly through the rest of the portfolio, we have to touch on diabetes.
The diabetes business saw strong organic growth, 7.1%, fueled by international strength and their new sensors.
And the MiniMed 780G was cleared for type 2 diabetes. That's a big market expansion.
A huge expansion. And the plan to spin off this unit into its own public company in the first half of 2026 is still firmly on track.
And robotics with Hugo continues to tick off those milestones.
Absolutely. The Enable hernia repair study met its endpoints. They launched the Embrace Gynecology U.S. pivotal study.
But the real catalyst to watch is U.S. approval for urology, right?
Right. They're targeting that for the back half of this fiscal year. That U.S. launch will be the next major inflection point for Hugo.
Okay, before we zoom out, they mentioned early positive signs for Ultiviva.
That's their new device for urge urinary incontinence, which affects 16 million people in the U.S.
And the selling points are that it's minimally invasive and has a really long battery life.
15 years. So it suggests they're finding success in these high-volume niche areas. The only real weak spot continues to be MedSurg.
Grew at just 1.3%.
Modestly, though management does expect a slight rebound in the second half.
Okay, let's pivot to the forward-looking financials. Despite taking that margin hit we talked about to fuel PFA and RDN, the strong quarter let them raise their guidance.
Yes, and the market loves to see that kind of confidence. Full-year organic revenue guidance was raised to about 5.5%, up from 5%.
And non-GAAP EPS guidance was also raised.
Yep, to a tighter range of 562 to 566.
We do have to acknowledge the external noise, though. What's the explicit headwind they factored into this?
Tariffs. That remains a measurable constraint. The guidance explicitly accounts for an approximately $185 million tariff headwind for the year.
And you should note this is front-loaded.
It is. The biggest chunk, about 90 to 95 million, is expected to hit in this current third quarter.
So management is basically saying, even with this significant pressure, our core growth is strong enough to raise the baseline.
That's the message.
So connecting this to the long-term story, how does management see the financials shaping up once these platforms really mature?
They're projecting high single-digit EPS growth for fiscal 2027.
And that relies on two things.
Two crucial factors. First, continued revenue acceleration from PFA and RDN. Second, a significantly less dilutive business mix.
As those PFA sales shift from low-margin machines to high-margin catheters.
Exactly. Plus, the diabetes unit, which is a drag on company margins now, will be deconsolidated after the spinoff.
And they're still looking at M&A.
Always. Tuck in M&A in high-growth areas like cardiology and neuroscience, supported by their ventures arm, which has stakes in under 50 early-stage companies.
Right. This brings us to our final segment. We're transitioning from reporting the facts to presenting a highly specific, high-conviction, but explicitly non-financial advice trade idea.
And my thesis is all about the PFA and Hugo Catalyst stack. The PFA data is it's undeniably the core driver right now.
71% global growth, 300% plus U.S. growth.
Right, and management's goal to add $1 billion in incremental revenue. Medtronic is poised to take significant market share in that $12 billion EP ablation market. They're turning a very large ship very rapidly.
That PFA story alone is a strong, long argument.
Mm-hmm.
But for it to be outrageous and plausible, we need a multiplier effect.
We do.
What makes this a bet on a sector re-rating, not just good execution?
The multiplier is Hugo Robotics finally getting that U.S. regulatory traction. So here is the outrageous but plausible trade idea.
Okay, let's hear it.
Purchase Medtronic equity, but at the same time, buy out-of-the-money call options expiring 18 to 24 months out.
So you're buying the stock for PFA, but the OTM calls are for something else.
Exactly. You're buying the inexpensive, long-shot bets on a catalytic event. You are betting on the convergence of two major events.
PFA's continued success and Hugo's U.S. approval.
You are specifically betting that the U.S. Hugo approval for urology and gynecology, expected in the back half of fiscal 26, combined with this proven PFA acceleration, will force the market to re-rate Medtronic.
From a value MedTech stock.
To a growth compounder. The combination of PFA success and Hugo's commercial launch in the high-growth robotics sector could catalyze a fundamental shift in perception, driving the stock above its prior high within 2 years.
That is a powerful combination of near-term execution and long-term pipeline leverage. So to recap this deep dive, Medtronic delivered a clean beat on revenue and EPS and raised guidance.
The momentum in pulsed field ablation is just enormous. It's validating their decision to focus on strategic offense.
And they are positioning Symplicity RDN and Hugo Robotics for major market entry.
The central narrative shift is confirmed. They are successfully transitioning from operational defense to aggressively funding high ROI platforms.
And they're consciously absorbing that near-term margin pressure to secure a long-term high-margin revenue base.
All despite macro noise and explicit tariff headwinds.
And here is the thought we'll leave you with. Now that the critical CMS coverage is settled for Symplicity RDN and the clinical data is so overwhelmingly strong, how quickly can management actually train the thousands of physicians, build out the hospital programs, and scale consumer awareness to capture that 18 million patient U.S. opportunity?
That speed of execution, not the size of the opportunity, is the critical question to track moving forward.
We hope this shortcut helps you in your own learning journey. Remember, this is analysis, not financial advice.
Thanks for joining us.
We'll catch you on the next deep dive.